In March this year, the United States ordered Chevron, the world's largest energy company, to completely end its oil operations in Venezuela by April. This move effectively signals the end of the U.S. oil sanctions exemption for Venezuela. Following this, Trump announced a 25% tariff on countries importing Venezuelan oil and gas. On the surface, it appears the U.S. is targeting Venezuela, but the real target is actually China. As the largest buyer of Venezuelan oil, a 25% tariff would significantly impact China's energy sector. Surprisingly, China didn't slow down its imports. In fact, they surged. In March 2025, Venezuela's daily oil exports to China are projected to hit 400,000 barrels, potentially a record high since June 2023. So why did Trump move against Venezuelan oil, and why is China ignoring the ban? Before we dive deeper, don't forget to subscribe to our channel to stay updated with our latest videos. Now, let's get into today's topic. Venezuela is home to one of the largest oil reserves in the world. Official data shows the country holds 300 billion barrels, about 18% of global reserves. According to OPEC, in January 2025, Venezuela's daily crude production reached 1.031 million barrels, up 33,000 barrels from the previous month. As the Western Hemisphere's top oil producer, Venezuela ranks fifth globally, contributing around 3% of the world's crude output. With such resources, Venezuela should be one of South America's wealthiest nations. Yet the reality is starkly different. Despite abundant oil, poverty persists. Inflation, though recently at a 12-year low, remains far above the regional average. My research shows this is largely because of the U.S. shale oil revolution, which boosted domestic production and slashed imports. By 2016, when the U.S., the world's largest oil consumer, reduced imports, global oil supply outpaced demand and prices plummeted. In 2017, to protect domestic energy interests, the U.S. imposed strict sanctions on Venezuela's oil sector, threatening secondary sanctions on other nations. This caused Venezuela's crude output to drop from 1.9 million barrels per day to just 350,000 barrels by 2020. Considering oil contributes nearly one-third of Venezuela's GDP and over half of its government revenue, this was, honestly, devastating. Yet Venezuela didn't yield. In 2019, it even severed diplomatic ties with the United States, a rare move globally. Under the Biden administration, global oil supply faced disruptions from sanctions on Russia, prompting the U.S. to allow companies to operate in Venezuela by late 2022. Today, U.S. firms produce about a quarter of Venezuela's oil and a third of its exports. Despite appearances, the U.S. has aimed to tighten control over Venezuela's oil. If Trump returns as president in 2025, U.S. energy firms will be required to phase out Venezuelan operations completely by April. Trump's decision to end Venezuela's oil exemption may seem sudden, but honestly, it's more strategic than it appears. In March, he issued an order to impose sanctions on any country importing Venezuelan oil, known as secondary sanctions. From April onward, nations importing Venezuelan oil could face tariffs up to 25%. Trump also claimed Venezuela was sending criminals, including violent actors, to the United States. While Venezuela condemned the move as illegal, the underlying aim is clear. These measures are designed to pressure China. China relies heavily on Venezuelan oil. By 2024, about 68% of Venezuela's oil exports, roughly 500,000 barrels per day, are destined for China. China's investments in Venezuela's energy sector have further strengthened this reliance. Trump's broader trade strategy includes a 20% tariff on all Chinese goods and 25% on steel and aluminum imports. If China continues importing Venezuelan oil, tariffs could effectively rise to 45%, and even higher for steel and aluminum. Secondary sanctions on Venezuela thus become a tool to economically pressure China. China, however, is not backing down. As Venezuela's strategic partner, China has invested over $55 billion in its oil sector between 2007 and 2017. Energy security is vital for China, the world's largest industrial nation, with manufacturing consuming over 30% of global output. After the U.S. announced the 25% tariff on Venezuelan oil, Chinese energy firms actually ramped up imports. By March, exports from Venezuela to China are expected to reach 400,000 barrels per day, a new high. China has also retaliated with tariffs on U.S. energy machinery and agricultural products, causing U.S. car exports to China to drop by 70%. American consumers, meanwhile, bear the cost. A 25% tariff translates to an additional $5.2 billion in fuel costs annually, and around 260,000 oil and gas workers in Texas could face unemployment. Meanwhile, countries like Brazil and Argentina are joining the China-Venezuela energy network, while Chinese engineers are building submarine cables and infrastructure to boost non-oil exports, which actually rose by 67% in just one quarter. China's energy supply is, really diverse. It has expanded oil imports from Russia, secured massive contracts with Saudi Arabia, and is developing a global import network through the Belt and Road Initiative. Even with United States sanctions on Venezuelan and Iranian oil, China is prepared to push back. The United States' tightening grip on energy exports shows increasing pressure on China. But considering China's diversified energy network, these unilateral sanctions may have limited impact. From China's perspective, it is ready to confront the United States on energy, protecting both national interests and long-term growth. So, do you think the United States can successfully block these energy supplies? Subscribe to our channel and turn on notifications to stay updated. We'll continue bringing you in-depth analysis and breaking news on global energy and trade.